Bonds are a type of financing tool that a company has at its disposal. There's two types of financing that a company can choose, and they can do a mix of both. You could do equity financing, which is sales of stock. So sales of ownership would be equity financing. So if you use that type of financing, you're actually giving away ownership in your company. Not giving, but you're selling. Debt financing is where instead of raising funds through sales of ownership, you're doing it with debt. So it's still a financing option, but this time you're giving out a promise to repay. So it's like a loan. And that's what bonds are. Bonds are debt financing. There are several different types of loans when you talk about those. Secured, not loans, I'm sorry, I think I said loans, but bonds. A secured bond is a bond that is secured by something, by some type of asset, kind of like having collateral when you talk about loans. If you have an unsecured bond, then this one is given just simply by the credit of that company or that creditor. So you'll hear these referred to as debenture bonds. A debenture bond is an unsecured bond. It's, again, just based on the creditworthiness of that company. No other backing behind the bond itself. You could have bonds that are convertible bonds. A convertible bond is something that when you sell the bond to someone, that person pays you money and they now hold a debt that you have to pay back. If it's a convertible bond, though, what you can do is part of the bond issue states that you could, instead of paying them back the money, you could issue them stock instead. You can convert the bond into stock at some point in time. So pretty much you change the debt finance to an equity finance. You don't have to, but you have the ability to convert the bond. You could also have a bond called a callable bond. And bonds that are callable means you don't have to wait until that maturity date. Kind of like a loan or a note, bonds have a maturity date. And at the maturity date, the company then owes that money back to the customer that holds the bond. Well, if it's a callable bond, you can call the bond in or redeem the bond, pay the bond back earlier than the maturity date. So it gives the company some flexibility. A lot of times, favorable interest rates is a reason that companies call the bonds back in so they can reissue them at a lower interest rate and pay less interest on the bonds. Bonds are like notes in a sense that they pay the holder of the bond interest. Just like if you took a loan out with a bank, you're going to have to pay them interest. You're also going to have to pay a bondholder interest. Now, as long as you've got good cash flow, and that might not be a problem, but if you're tight on cash, that could be an issue. So you have to take that into consideration when you decide what type of financing that your company might want to do. But an upside to bonds or debt financing is that the interest is deductible for tax purposes. So it does decrease your taxable income when you have that interest expense. The face value of a bond, we've talked about face value before with other types of liabilities, notes specifically. When you have a bond issue and you sell, if you're the company, sell bonds, or if you're an individual investor and you purchase bonds, there'll be a face value, and there'll also be on the bond issue a stated or a contract rate of interest. The face value is how much the company will pay you upon maturity. So most of the time these are in some type of a multiple of $1,000. So if it was a $1,000 bond, that's the face value. That's what the company is going to pay on the maturity date, $1,000. And it will also have stated or coupon or contract, you'll hear all those, interest rate. And if it was, say, 6% interest, you're going to pay 6% of the face value of that each year. Or if you pay it semi-annually, then you'll pay half of that twice a year. So you do pay interest as well as repaying the face value back to the holder of the bond. Now, you also have to consider market interest, though, when you deal with bonds, because that determines how much you sell them for. Just because it says it has a face value of $1,000 doesn't mean that you're going to get $1,000 for it. You could, but not necessarily. So the specific issue price itself has to consider market interest rate and the coupon or the stated rate. Now, if we wanted to get into exactly how much we would charge for a bond issue, then we're going to have to use the time value of money. Okay? Time value money will tell me exactly how much. We're going to use things like, if you've ever dealt with time value money, you deal with future values, present values. We would deal with present values here. I would want to know, okay, if I'm going to pay $1,000 on this bond in 10 years, what would that be worth to me today if I could earn interest on it as an investment over time? It's going to be something less than $1,000, I would think. Might not be, but you can use present value calculations to determine what that value would be today. So that is going to depend upon the money that will be received. You're going to pay them a face value. You're also going to pay them interest payments, however, annually or semi-annually, however often, quarterly. So you have to take that into consideration. You also have to take into consideration when it will be paid, because interest will compound each time that you pay that. And you also have to take into consideration the interest rate. Now, in general terms, we can compare market interest and stated interest. And I can tell you in general what we would issue the bonds for, not an actual dollar value, but I can tell you if we would issue them at the face value, above face, or below face. If you issue something above face value, that's what we refer to as a premium. If you issue them below face value, then that's what we call a discount. So if you had a market rate of interest and it was greater than the stated rate of interest, then those bonds are going to be issued for a discount. So think of it like this. If the marketplace, so you're out in the bond market where you can buy and sell bonds, and you're looking to buy a bond, and the market rate of interest right now is 10%, but you find this bond and it's only offering 8%. Well, do you want to buy that one, or do you want to buy one that's at the market rate of 10%? Probably going to go for something else. So how could a company entice you to buy their bond if they're only offering 8% interest? They can offer it to you at a discount. So you only pay them something that's below that face value, and again, say it's $1,000, but when it matures, the company's going to pay you $1,000 back. They're going to pay you more than what you paid in. Plus, you're going to get interest each year, or again, maybe twice a year, maybe quarterly. If, however, the market rate is less than the stated rate, then we're going to issue those bonds for a premium. So, again, if the market rate's at 10% we talked about before, but now you have a bond that's trading at 15%. Oh, well, then it's really attractive. Everybody wants that one because it's paying more than the market. So you can ask for more than the face value for those bonds. So those will get a premium, something over face value. Now, if the market rate and the stated rate are exactly the same, let's say 10% is the market and my bonds are 10%, then I'm going to get them, or I'm going to issue them at face value. So I'll get $1,000 if that was the face value of my bonds. Now, issue prices are usually quoted as a percentage of the face. So let's assume, let me give you a little bond issue. Let's assume that we issue 10-year, 5%, $1,000 bonds, and let's say that they're dated January 1st of the current year. All right? So I look, and we're going to issue these. Let's say we issue them at 100. That 100 tells me what percentage of the face value they were issued at. So these were issued at 100% of face value. So I'm going to get in cash the same as the face value. So let's make our journal entry if we issue them at 100. Well, our issue is 10 of them, 10-year, 5%, $1,000 bonds. So that means I'm talking about a total face value of $10,000 here. So I'm going to get cash of $10,000 because they were issued at 100. In other words, the market rate of interest has to be 5% as well because the stated rate is 5%. So these are being issued at face. So I get $10,000 in cash, and now I record a bonds payable. I'm going to owe $10,000 in 10 years when these mature. Now, what if, however, instead of at 100, these were issued at 102? That means 102% of the face value. So now, how much cash should we get? Again, the face is $10,000, and I'm issuing at 102, which is 102%. 1.02 is a decimal. So now I should get $10,200 in cash. These were issued at a premium. So this means that, okay, the stated rate was 5%. The market must be below that for me to get a premium for these. I'm still going to have bonds payable recorded, but I do not record them at $10,200 because I'm not going to pay $10,200 back at the maturity date. The only thing you pay back at maturity is the face value of the bonds, which is $10,000. So I'm out. I need another credit of $200 here to make my journal entry balance. And we credit that to an account called premium. I'm going to have to take up 2 spaces here. Premium on bonds payable. A premium account. Okay. Give me one other option. What if we issued it at 96? So now we're issuing it at 96% of the face. So 0.96 as a decimal. Our face is 10,000. So now I'm going to receive cash of $9,600. Now I still have bonds payable of 10,000. So that means I've got something that needs to be debited for $400. And we issued these at a discount. And so we're going to use an account called discount on bonds payable. Running out of space here, sorry. And then we credit bonds payable for the full face amount because that's how much I'm going to repay in 10 years at the maturity. This also brings up another topic or a term called carrying value. Carrying value is the difference between the face amount, or the amount recorded in bonds payable, which is the same thing, that will always be face, and either the addition of a premium or the subtraction of a discount. For instance, when we issued them at 102, we had a premium. My carrying value at the time is $10,200. It's the face plus the premium. When we issued the bonds at 96, we issued them at a discount. So the carrying value here is $9,600. It's the face minus a discount. So carrying value in general, we can state it like this. It's the face plus a premium or minus a discount. You'd have one or the other. Now if you issued that at face, the carrying value is the face amount. But if you had a premium, you add it. If you had a discount, you subtract it. And you'll see that these accounts go together on the balance sheet. Bonds payable will be matched up with either its related discount or premium account if it has one, if it's applicable. So on the balance sheet, if you had a premium, it would add to the bonds payable account. If you had a discount, it would subtract from the bonds payable account. So you will be able to see the carrying value on the face of the balance sheet. The whole point with a carrying value, and why we keep up with it, is eventually, like we've always said, we're going to pay $10,000 at maturity, as long as these aren't callable bonds. If they mature, that's how much we're going to owe back, is the face. For these, that'd be $10,000. So we got that issue at 96, so let's take it as an example. This had a discount, so right now the carrying value is lower than the face. It's at $9,600. Over time, we want to somehow do something so that by the end of the 10 years, the carrying value is $10,000. So we actually need to get that discount account gone. It needs to equal 0 by the end of the 10 years so that the carrying value is the face amount, because we need to pay $10,000 at that point in time. So we want to somehow decrease this account. Same thing for premium. Premium means we have a carrying value over the face. We need to decrease that premium. We need to get that carrying value down to $10,000. When you have a discount, you have to increase it up to the face. And how we're going to do that is by amortizing the premium or the discount. We've talked about amortization before with intangible assets. So it's very similar. If you have a premium, you amortize it. If you have a discount, you amortize it. It's just that they hold different values, so how we amortize it is going to be different. So we're going to use a simple form of amortization. There's more than one method or way to do amortization. We're going to use the straight line method. So it's like straight line depreciation. So I'm going to use the numbers that we had before. The premium that we just had when we issued our bonds at 102. We had a premium that was a total, I'll write up here premium so you remember which one we're doing. That premium was a total of $200. Alright? And for straight line, we're going to divide that by the term of the bonds. And for us, that's 10 years. So if we do this annually, that's going to be $20 per year. Now, if you amortize this semi-annually, then that'd be $10 every 6 months and so on. But let's assume that we just do this annually. When I need to amortize the premium, I can do it one of two ways. I can amortize it by itself, or I can do it along with the interest payments. So again, if you did this semi-annually, you divide this in half. The same thing with the interest payment. But let's assume for just some simplicity to make sure we're understanding that we pay interest once a year. We also amortize this premium once a year. First way we're going to do it, let's just assume that we amortize the premium by itself. Okay? If that's the case, the premium account when we created it had a credit balance. We want to get rid of the premium account so that the carrying value can go down to the face. So we need to decrease it. If it has a credit balance, to decrease it, we need to debit it. So we're going to have that premium on bonds payable, and we're going to debit it for this $20. And the credit is going to be to interest expense. Premiums decrease our total amount of interest expense. You'll find in a minute that discounts do the opposite. Right? That would be the individual entry here. Now, if for some reason we were going to do this in conjunction with interest, then first we need to calculate our interest. And if you remember, our interest was, it was 10-year, 5%, $1,000 bonds. So if we pay annually, we're just going to take that $1,000 and multiply it by the 5% because it's a per annum amount. So that's $50 annually. Again, if it's semi-annually, then it would be $25 every 6 months, and so on. So if you were making these individually, okay, here's how you amortize, and then your entry for the interest payment, because you have to pay the bondholders cash. That's part of having bonds. You would have interest expense debited for $50, and you would credit cash for $50. Or if you were just accruing it and going to pay it next week, say that could be interest payable for $50. But let's say that instead of doing two separate entries, you decide you want to amortize the premium or the discount, I'll show you that one in a minute, and pay the interest at the same time. So we can do that. We'll use these exact same numbers. So to do it together, remember we still have that premium account that needs to be decreased, and we debit it for that. So premium on bonds payable. You know what? Let me put this, let me erase, let me start over. I'll try to put this all on one line so it won't get confusing. So premium on bonds payable. Alright, again, I'm just changing, instead of doing two, I'm just doing one. We decrease that $20, so we debit it for $20. But then we're also paying interest, so we have interest expense. I'm going to leave that blank for just a second, okay, because I want you to focus. How much cash did we pay? That's the only credit in this journal entry. If you remember back to just a second ago, we calculated out, we really are going to pay $50, and that's it, okay, 5% of the $1,000 annual amount. So interest expense has to be $30. All right, remember what I told you about premiums. Premiums decrease interest expense, because our interest expense here would have been $50 based on, again, paying the interest on the cash, but when we amortize the bond, it decreases interest expense by $20. So overall, we have interest expense of $30. Right? So there's, again, two ways we can do that. Now you can do the same thing with a discount. So the discount, when we issued them at 96, if you want to go back and look, you can, but we had a discount of $400. If we do straight line amortization, again, we divide by the term of the bond, so 10 years. So this means we're going to have $40, again, annually per year. If you did it semi-annually, you need to divide this in half. It'd be $20 every 6 months. So if we just amortize the discount by itself, a discount when we created it was a debit balance. I want to make it go away so that we increase the carrying value up to the face amount. So we're going to credit that. So this time I'm going to debit interest expense to amortize because we're amortizing a discount. So we debit that and we credit discount on bonds payable. That's just an individual entry for amortizing the discount. Again, you could make the same entry for calculating the interest if you were doing it individually. But what if I wanted to combine the two with the discount? Okay. To do that, I know I'm going to have interest expense involved. But again, let's leave that for just a moment. How much cash am I going to pay? We've talked about this already. We really will pay $50. And the discount holds a debit balance. We need to credit it to make it decrease. So that discount on bonds payable, we credit for $40. So interest expense has to be $90. Again, if we had done these individually, when we pay the $50 cash, that's going to be debited to interest expense for $50. But you also see here that that discount amortization increased interest expense by $40. So overall, those two would have impacted it by $90, and you see that here in the combined entry. Discount amortization increases interest expense. Premium amortization decreases interest expense.